The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A technical breakdown in the tech trade amid then trading into the Thanksgiving Day holiday. Live from Studio 2 here at Bloomberg headquarters in New York. Gobble, gobble. I'm Romaine Boston.
That sounded like a Dr. Seuss rhyme, what you were just saying.
I know.
You planned it that way. I know.
Well, sort of.
I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. The S&P 500 ending a 7-day rally, retreating from its 52nd record high of the year following a huge data dump because of Thanksgiving and the holiday shortened trading week. You are seeing tech as the weak link here with the NASDAQ 100 off by 0.9%. Treasuries are rising. That is pushing yields lower across the curve. We had a 7-year note auction today where demand was fairly decent, and the dollar lower by about 0.6% on month-end flows, contributing to that dollar weakness. Still, strategists are looking for a strong dollar in 2025, Romaine.
Yeah, absolutely. We started off silly here, but we do have to get serious because we talk about that 7-day rally in the S&P 500. Looks like it's coming to an end here on Thanksgiving Eve, the last full trading day of November, we should point out. But whatever is ailing big tech today and the Mag 7 all week, a lot of investors still see broad room for this rally to resume when traders do return from the holiday slowdown on Monday. After all, why would you fight this tape when the benchmark index as a whole is still in a technical uptrend and the SPX minus the Mag 7 and minus big tech? Well, guess what? That's even on a steeper climb. Most Wall Street strategists finally starting to get that message. That includes JP Morgan, which after 2 consecutive years of standing by bearish forecasts is now predicting a gain to 6,500 for the S&P next year. That's up 55% from a forecast of 4,200 that it had held throughout the past 2 years. Capitulation. And that comes at an intriguing time as economic and market conditions are probably facing more uncertainty heading into 2025 than they did heading into 2024. And maybe that's why more traders are clinging to the economic data dependency, including the latest GDP update this morning, an update showing a broad advance in consumer spending last quarter. Monthly data also out today showing better than expected increases in employee compensation, personal income, personal savings, and personal spending. Yippee, right? Well, unfortunately, Scarlett, that same report showed that the Fed's preferred measure of inflation accelerating from a year ago.
Yeah, and that's having ramifications across how traders are pricing in rate cuts. In the last month and a half, traders have been pricing on fewer rate cuts for 2025. Now, back in mid-October, right around here, the market was anticipating 4 to 5 cuts in 2025. At the end of last week, that was ratcheted down to just over 2. And today, we're looking at somewhere between 2 to 3 cuts. As core PC picked up in October, as Romaine said, a sign that inflation is still sticky in the final mile to the Fed's 2% target. Making the Fed's policy path that much more complicated is Donald Trump's pro-growth agenda that features tariffs, tax cuts, and deregulation, all of which may end up being inflationary. Romaine?
Let's kick you off to the close here on this Thanksgiving Eve, Wednesday here in the United States of America. Tracie McMillion joining us, head of global asset allocation strategy with the Wells Fargo Investment Institute. Everyone looking at some of the recent market moves, and to Scarlett's point, Tracie, there's a big question here about what the setup is into 2025. Do you sort of continue this theory, this bet here, that this rally will continue and continue to additional record levels?
Yes, thank you, Romaine, and thanks for having me. So we do think that 2025 will be a good year for earnings. We think it'll be a good year for stock prices. And what we see evolving is perhaps some choppiness here in the intermediate term, because we do see the potential for a bit of a slowdown in economic growth, followed by a pickup in economic growth in 2025. We think that's going to support earnings in the range of about 12% next year for the S&P 500. And so that gives us lower teens upside potential within the large cap space for next year.
I am curious, though, when we talk about how you allocate or how you sort of find those opportunities, and you go through kind of what we've been for this year, pretty much every S&P sector nursing some pretty sizable gains. And this is probably going to shape up to be probably one of the better years that we've had in aggregate in quite some time. So when you do get these sort of pullbacks like we got this week, a modest pullback this week, or more severe pullbacks to come, do you use that as an opportunity to enter new positions?
So we would be using any pullbacks, any choppiness to enter new positions to add money to certain sectors. And we like the cyclical sectors here of communication services, financials, industrials, energy. All of those sectors look relatively attractive to us. And of course, technology has been one of the top performing sectors this year. We think that probably goes to market perform in 2025. So we're neutral there.
So when you talk about cyclicals, especially financials, I'm thinking small caps. And we've been waiting for the sustained gain in small caps. And it comes in pushes and pulls, right? We get close and then we kind of don't quite get there. What is your outlook for small caps versus big caps when you are positioning for 2025?
Yeah, thanks for that question, Scarlett. So we see the most recent moves in small caps as more of a reaction than a rotation. So we recently moved our small cap position over the past couple of months. We moved it up from an underweight to a neutral weight because we did see the potential for lower rates benefiting small caps, but maybe not to the extent to which they have rallied here. We think that we're going to need some more fundamental support for small caps before we would be more favorable and adding money there. So what we've seen is that earnings forecasts have come down while prices have gone up, and we'd like to see some improvement in those fundamentals.
And I'm guessing a lot of that is tied to this idea that you were telling us about a pickup in economic growth in the second half of 2025. What's going to catalyze that pickup in mid-2025?
Sure. So we are seeing the potential for higher growth next year than we originally forecast because of the deregulation, because of the tax cuts. We think that all of that will spark additional growth. Consumer confidence has also risen and asset prices have risen, and that will also help to support consumption going into next year.
Tracie, when you look at the risk and the big risk, I'm talking about those sort of big, not quite black swan, but maybe something close to it here.
Dark gray.
What's on your radar? I mean, what do you sort of have in the back of your mind to just say, keep my eyes open, keep my ears open?
Yeah, we always have to have that, Romaine, as you know, and geopolitical risks, event risks like that are probably top of mind right now for something like a black swan event. And to hedge against something like that, we're telling our investors to make sure that they have an allocation to commodities, oil and gold in particular. And for those investors for whom it's appropriate, alternatives like hedge funds could also be a stabilizing asset class within a portfolio in the event of some event risk like that.
Do you recommend that folks have downside protection, or at least downside protection that's maybe a little bit broader than what we see currently in the market in aggregate? And more importantly, do you advocate at all protection against volatility?
Yeah, so we think that diversification is great protection against volatility. And so having an allocation to equities, to fixed income, commodities, alternatives if appropriate, and combining those assets into a portfolio is a great way to mitigate some of the downside risk, even against a lot of the negative events that we've seen historically.
Tracie, you named a whole bunch of assets there. What's going to lead? Which asset class will lead the way?
Yeah, so we think equities continue to lead the way in an environment where we're seeing improving growth, where we aren't necessarily seeing rates move into a point where they would be restricting that economic growth, where companies are continuing to really deliver on their margins. That to us says that this is a good environment for equities, even though valuations are getting stretched here.
Tracie, gonna have to leave it there. I've been doing the show for several years, Tracie, and every time I talk to you, you're always smart, always kind, always pleasant. Wish you a happy Thanksgiving, and we'll catch up with you in a few weeks, I'm sure. Tracie McMillion there, the head of Global Asset Allocation Strategy at the Wells Fargo Investment Institute, kicking us off to the close here on this Wednesday afternoon with a closer look at the Trump trade, a trade that says chips are out and software is in, a deeper dive into where traders are positioning themselves ahead of Trump taking office in January.
Plus, there's no place like home for the holidays. You just have to get there first. A look at some of the biggest trends during a week expected to break travel records. You're not going anywhere.
Are you going to be one of the people in that line later today?
No, I'm avoiding that completely.
All right, well, that's good, Scarlett, because you only have 28 days to find me a gift. The holiday shopping season kicking off, of course, on Friday, the biggest day of the season. We're going to take a look at how far Americans will go this year to score the best deals. All that and more coming up in a bit. This is The Close on Bloomberg.
Investors are rotating out of the chip sector and into software. Traders see AI growth moving to software, while semiconductor companies face tariff risks, especially after President-elect Donald Trump this week vowed to impose additional tariffs on China and slap tariffs on Canada and Mexico. Joining us now to discuss is Bloomberg's Ryan Vlastelica in Chicago. Ryan, I get how chips are kind of in the bullseye of Donald Trump's tariffs and trade war risk. In addition, they're part of the CHIPS Act, which Trump has made clear he dislikes tremendously. But is software not at all a target, or it's just that Donald Trump hasn't really trained his eye on it yet?
I'd say it's more the latter. So software, for obvious reasons, it's not going to be as impacted by any sort of tariff changes in policy. It's not, constructed overseas or anything like that. So you don't have those kinds of, tariff-related issues that are going to come up here. And like you mentioned in your intro, we are expecting to see the AI component of software become more prevalent in the coming quarters and years. We are seeing more and more AI services getting rolled out. We are seeing more monetization. We are seeing a lot of growth in cloud computing, and so on and so forth. So while we've seen a ton of money being spent on the AI infrastructure side of thing, which has obviously been a huge tailwind, most notably for NVIDIA, we are expecting, at least the consensus is that we will start to see this shift a little bit more over to software and more monetization there. So they are probably looking at a growth upswing over the coming years, whereas we've already seen a lot of growth within chips, and the valuations reflect that.
And the software space also potentially sees a lot of consolidation opportunity as well.
Yeah, if there are fewer regulations under the new administration, if there's a little bit more leniency when it comes to M&A, software is considered an area where that is sort of ripe for consolidation.
So we talk about this idea of kind of where the puck is going, and obviously this is still a lot of speculation here. Are people that you're talking to, are they breaking this down into, I guess, more kind of subsectors, if you will? Because it's one thing to look at software as a whole, and we already know there are certain companies that are probably not going to be in favor in the Trump administration. So how are those investors sort of parsing which parts of that sector are going to benefit?
Yeah, that's a great question. I think obviously AI is just the central theme really across software. And there are some companies we saw this past earnings season, companies like Snowflake, like Palantir, Microsoft, Oracle. These are names that are starting to see a little bit more of a pronounced tailwind already from AI, to the extent that they're able to continue showing this kind of growth, showing this kind of demand. You would probably expect people to continue rotating into those companies, especially ones like Microsoft, Oracle. These are pretty established names. They are very strong in terms of cash flow and earnings durability, so on and so forth. Like, these are the kinds of high quality names that if there is this sort of broader uncertainty, maybe a slowing in economic growth, these are the kinds of areas you would expect people to be rotating into, even regardless of the AI tailwind. I
am curious as to when we're going to start to see some of these software companies articulate a little bit more aggressively their outlooks for 2025 and beyond. I mean, we always focus so much on NVIDIA sort of being the last big tech company to report. We kind of forget that Salesforce is still lingering out there on the software side. I think they report next Tuesday or Wednesday, if I have that correctly. Any chance that you think Benioff and his team will go a little bit further out in the limb than maybe what we heard from some of the other big software companies?
Yeah, that's going to be a really key report. In fact, because Salesforce has been implementing all these AI agents, and they've been investing a lot in this technology. They made a ton of AI-related acquisitions over the past few years. They're a pretty good name to look at if you're trying to see which way the wind is blowing. Now, we've seen some disappointments from them in the past. I think it was in May, the report then, where they kind of indicated, maybe the AI tailwind is a little bit further out, maybe a little bit smaller than people were hoping for, at least in the near term. But if they do come out and they kind of are able to put a little bit of a finer point on it in terms of what they're expecting as far as growth, as far as adoption, you can probably expect to see that sort of flow through to the rest of the software space as people become more optimistic about this, the kind of broader opportunity that might be ahead.
All right, Ryan Vlastelica, Bloomberg reporter over there in Chicago, a closer look here at the Trump trade and maybe some of the favoritism investors are having right now for the software side of it. Even, of course, when you talk about the AI components, Salesforce, of course, really trying to pimp its AI agent. And it gets to the question, what are these companies doing with it? There was a great story today about the Vatican and how it's been working with Microsoft to create basically an AI-generated version of St. Peter's Basilica. The idea is that, once you kind of have this sort of AI model, you can do things like monitor whether, it needs fixing up, if you want to buy a ticket, or you just want to just tour it without actually physically touring it.
And this is important, right? Because the Vatican is going to be celebrating its 2025 Jubilee. It's a holy year, and more than 30 million pilgrims are expected to go through St. Peter's Square and everything. And this would maybe relieve some of the pressure there that they face and allow people to kind of partake in it.
Yeah, this has always been on my bucket list, but of course, who wants to stand in line for 20 hours or whatever?
Well, you can go onto their AI site and
well, that's what they're saying. They're promising that somehow this will be, because you figure like with technology and modernization, shouldn't that come with convenience?
You're not buying it. You still want to go there, but have the door open for you by someone else.
Scarlett, have I mentioned that you only have 28 days to get me a Christmas gift? You better get out there and start shopping, because a lot of retailers out there, like Best Buy, they're already starting to ramp up the discounts, if you can believe it. I've been telling you about all this. Black Friday is already here. It's been here for a lot of consumers.
It has been. And
consumers are dishing out for discretionary products? Question mark. We're going to try to answer that question when we come back on our top calls. This is Bloomberg. All right, let's get a view from the sell side. Top calls time. The big movers on the back of analyst recommendations. And we're going to start off today with Workday, a downgrade to neutral from overweight over at Piper Sandler. Last night's third quarter results showing a slowdown in subscription growth, a 10th consecutive quarter of declines. Oof, that's making the analysts lose confidence that management has the levers to fuel a recovery next year. Those shares down 5% on the day. Next up, Paramount going to buy from hold over at CFRA. The analyst there, Ken Leon, citing the quote, what ifs surrounding Skydance's transaction with National Amusements for that controlling stake of the media company. Ken Leon expecting Skydance's management to capitalize by spinning off or selling some of Paramount's cable networks like MTV, Nickelodeon, and oh my gosh, not BET. Paramount up 1% on the day. And finally, Foot Locker. Its assortment of products taking a step in the right direction, according to Sam Poser over at Williams Trading, lifting his rating to a hold and a $21 price target. He does worry that Foot Locker is attempting to serve too broad of a consumer base, though he does say that the company's array of offers from brands like New Balance can offset diminishing allocations from companies like Nike. Shares moving higher on the day by roughly about 4%, and those are some of our top calls. Of course, with it being Thanksgiving Eve, and of course just a couple of days removed from the Black Friday shopping season start, we do want to focus here on the retail season and how that shopping season is going to go. Best Buy, Dick's Sporting Goods, and a bunch of other retailers already offering Black Friday and Cyber Monday discounts to attract those consumer dollars and attract them early. Let's get some insights out of Anthony Chukumba. He's senior research analyst over at Loop Capital Markets. Anthony, early October, I was getting emails in my inbox with pretty sizable discounts from retailers. Retailers that I did not see sizable discounts from last year or the year before here. Do you think that that early start to try to tantalize folks like me to buy early has worked?
I think that it has. I mean, so I think the reason that you got those offers even earlier, and it seems like, Black Friday weekend has turned into Black Friday week, has sort of turned to Black Friday month. But I think retail has gotten an even earlier start this year because we do have a shorter holiday selling season. Thanksgiving is very late this year, so there are 5 fewer shopping days between Thanksgiving and Christmas this year. And so retailers had to get an earlier start. I mean, Best Buy in particular said that they started their Black Friday sale a week earlier. And Best Buy, basically said for the first 3 weeks of November, comp store sales were up 5%. So it seems like it's working.
Well, that's what I'm curious about. And maybe we can stick with Best Buy for a second, because we talk about electronics always being kind of a hot holiday gift, whether you're buying for others or, as some people would do, buy for themselves. Is Best Buy going to be a beneficiary of that, or has the purchase of electronics moved to other platforms and outlets?
Best Buy has done a really nice job over the past several years of defending their market share. They definitely have overcome that sort of existential Amazon threat. And a lot of that has had to do with them investing their own omni-channel capabilities and really doing a great job of integrating the stores with BestBuy.com. So, for example, they said that about 45% of their online orders are actually picked up in a store, and about 60% of their online orders can now be delivered or picked up or available for pickup within one day. And so I'm not really expecting Best Buy to lose any market share during this holiday selling season. I think that they will completely hold their own, particularly given the fact that our work has shown that their prices are very, very competitive with Amazon's.
Absolutely. And that might be one reason why the actual comparable sales number was a little bit soft for the quarter that ended. However, the gross margin was better than expected. How much of that is due to spending on services like, whatever after sales service they do provide so that Romain doesn't have to install the TV on his own?
Well, look, I mean, Best Buy has definitely overhauled their services business over the last several years. So it used to be services really just meant warranties, which a lot of people are not huge fans of, or the Geek Squad, right? And the problem with the Geek Squad being, someone would show up at your house to install your router. Sometimes they would know what they were talking about. Sometimes they did not. Best Buy has really overhauled that. They've also added sort of these membership programs, where you can get some services thrown in or at least heavily discounted. And so they're doing a really nice job right now of attaching services, and services has become more profitable for them as well.
All right, so Romain, you should still install your own television, by the way.
I just used to just lean it up against the wall on the floor. Is that not how you're supposed to do it?
I don't know. We should ask your family about that. So, Anthony, final question to you. If people are buying their presents earlier, before actual Black Friday, because those deals were coming out in October, does that actually pull forward all the spending? Or will there still be a reliable group of people who will continue to spend as we get closer to the actual holiday?
I think you're always going to have your procrastinators, right? So, I mean, look, I do think that there probably was some pull forward in demand, but there will still be plenty of shopping that'll kick off, pretty much as soon as the Thanksgiving dinner table is cleaned off, and will continue right up until Christmas Eve.
Yeah, I guess we'll all be doing that while we're watching football games as well. Anthony Chukumba over at Loop Capital Markets, thank you very much. And speaking of sitting there watching football games and shopping, a lot of people are now using ChatGPT in order to figure out where to get the best deal.
I saw this. I've only kind of fooled around with it, like for travel and a couple of work-related things.
Did it work?
Mixed results, let's just put it that way. But I am intrigued by the shopping aspect of it, because I was reading this story, and the whole idea is that you can take sort of the SKU, the barcodes of the things you want, you enter them in, and then apparently, I don't know, ChatGPT does.
There's some magic.
Some magic where it kind of finds you a deal that might not be like public. That was the other thing. They're saying like retailers aren't really advertising some of their sales.
You might have to drive like 4 hours to get there and to pick it up and then bring it back home, but is it worth it?
No.
All right, coming up, lots of eco data to sift through this week. We've got Sonia Meskin over at UBS joining us next with a breakdown. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Scarlett Fu. We're probably the only people left here, so clearly we're not the ones preparing for Thanksgiving dinner.
Yeah, have you walked around the office
There's
today?
no one here.
Yeah, it's basically
we could go
you,
sing and
me,
dance
and whoever's operating the camera, which I think is just like one of those little birds that like goes up and down. Like
and our producers, as they reminded
like
us.
Simpson in the control room back there.
Oh yeah, the bird, the drinking bird.
In all seriousness, though, I mean, I don't know what you're doing if you're the type of person that cooks a big feast here.
My husband will.
But we were all looking at the price, the price of turkey. Remember, we talked to Stu Leonard yesterday. Remember him? He was fun.
Yeah.
He kept going on and on about how turkey prices were down. And they're actually saying that when you look at the cost of a meal overall, if you add up all the ingredients, it's actually not much higher than what it had been. And many of those ingredients are actually lower than what they were a year ago.
Yeah, including starting with turkey, which is usually the priciest part of the meal. According to the American Farm Bureau Federation, the cost of certain Thanksgiving items could bring the average meal to $5.81 a person. That's down from $6.12 last year.
Yeah, that's pretty good. It's, but you got to stick with the basics. The caviar on top of your
no frills,
or truffles or something like.
You do truffle and caviar on top of your turkey?
I can't get into truffles. Why are truffles a thing?
They're really good.
They're not.
Yeah, no, they are.
They're not.
All right. Well,
we're
we
going
can
to
talk
debate
later.
that after the break.
We'll come back to that later on. But, we talk about inflation. Obviously, a lot of U.S. eco data coming out this morning, from personal spending to the Fed's preferred measure of inflation, and that is core PCE. U.S. core PCE, that rose 0.3% month over month, and that really further cements the central bank's more cautious approach to lower rates, so long as the labor market does remain healthy and the economy continues to hold its own. Here with more insight on what all of this data means for the path ahead is Sonia Meskin. Sonia is U.S. economist over at UBS. So what did drive the pickup in core PCE? Because even though it came in exactly as what economists anticipated, on a year-over-year basis, 2.8%, that was still a pickup from the previous month.
That's right. And we've seen this actually play out even prior to this release, right? And we have expected some bumpiness along the road. And in fact, the FOMC alluded to it themselves. What really was interesting about this report is that you saw the core measure X housing and energy pick up, which is what the Fed traditionally has said ever since this inflation bout of post-COVID. This is the measure that we're very focused on. But they appeared very chill when it came to the minutes about inflation. So we think we're going to look through that.
We're going to look through it. But people still feel that if it's 2.8%, that's a sizable increase from a year ago. It doesn't matter if it's, moving in the direction of what the Fed wants to see, 2%. Anything that's an increase, it feels like inflation that's unwieldy for people.
I think there are two things at play here. One, this is supposed to be temporary. We, in fact, expect it to be temporary, and the Fed expects it to be temporary. They've come out and said as much. This is something that will potentially persist. Apparel prices, some stickiness in shelter will potentially persist into the first quarter of next year. But even then, we expect inflation to continue to come down to 2%.
And even with inflation holding where it is, even if it stays there were a lot of positives in that same report, of course, with incomes being up, savings for some reason was also up. But then also we had the GDP report, and I know it's just a revision, but it also seemed to suggest here a resilient consumer and resilient business spending as well. That's right. Yeah. And that is something to keep in mind as well, is that wages are now growing on a month-to-month basis faster than inflation. So that does bode well for the consumer. We still think the consumer will slow into next year, primarily, because we think the lower tiers of the consumer are going to suffer a bit more and going to spend less. But for now, things are not looking bad at all for the consumer. And we've heard that from some of the lower tier consumers, particularly around Thanksgiving. They're either buying less food or being a lot more particular. Stu Leonard yesterday, runs a big grocery chain in the Northeast, kind of alluded to that. Turkeys may be down, but other things are up. I don't know what the price of truffles are, Scarlett, but I'm sure they're higher than they were. Higher. In all seriousness, though, how do you sort of model, I guess, some of the longer term risks, kind of the known unknowns? We have a new administration coming in with a president-elect who has proposed a lot of policies that, at least by traditional economic theory, would be inflationary. Well, economists do love deregulation and lower taxes, at least for the corporates. On the other hand, we have the proposed tariffs. This is really a tug of war between what we see as potential fiscal measures coming down the pike domestically and then the trade situation more globally. And it seems that for now, markets have decided that this has played out in favor of the fiscal. Right, so we have the term premium that is up 50 basis points since September. We have expectations for Fed cuts that are down since September, and yet we have credit spreads that have narrowed and stocks are up. So deregulation and M&A may be good for financial assets, but it's not necessarily good for people and they're paying prices on consumer goods. Not necessarily. And one area to watch out for, we would say, is the potential divergence, which you haven't seen yet, between inflation break-evens and real rates. So if we see, for example, inflation break-evens remaining sticky and real rates coming down, then it could be that investors are looking at a stagflationary impulse. That is something that could be reflected from tariffs. And won't that start to show up in inflation expectations and consumer confidence surveys as well? And that becomes kind of a self-fulfilling prophecy in many ways. Potentially. We're not seeing that yet, but that is a risk that we're flagging. So, Sonia, I kind of want to just bring this kind of full circle, because we talk about the read on the economy. And I think if you at least poll folks in the market, at least in the U.S. markets, everybody seems to think everything's okay. And even if things aren't okay, they're not going to be awful. What is the big risk that you keep your eye on as an economist, say over the next 12 months or so, that not necessarily going to be a sure thing will happen, but you should certainly be mindful of?
Well, we should certainly be mindful of what happens with the consumer, because consumer sentiment is something that is very important for this economy. It's a big chunk of this economy. Also, if we continue to see businesses raising prices, not just as a one-off in expectations of tariffs, but on a continuous basis, that is a definite risk to inflation expectations, especially if they can pass on those prices continuously down to the consumers as well, not just intermediate prices.
But we've heard some of those companies already basically saying that, if the tariffs and some of these other policies does increase their costs, that they're very prepared to pass them on. Now, whether they're going to have that same power to do so like they had a couple of years ago, that's a big question.
That's a big question. It hinges on jobs and the consumer.
Yeah, absolutely. Have you started your holiday shopping already?
I started 2 months ago because that's when they started having the promotions.
Yes.
She's an economist. You're an economist at Heart, Romaine. Yes, you win. You
don't need ChatGPT. You need Sonia Meskin. She'll get you all the deals.
Romaine has been bragging for a long time that he's been shopping and he's all done with everything. So, Sonia, looking forward just to next week. I know Romaine was asking about, your 12-month outlook. We've got data coming out next week, and it's going to kind of set the tone for the rest of the month, the sprint until the end of the year. What are traders and investors going to be focused on towards the end of the year to determine whether this rally continues even further?
Well, we think the employment situation is still very important. There's a lot of noise around that, of course, given the hurricanes and the strikes, etc. But it will be important to try to at least tease out the trend, the underlying trend. What are we starting the next year with? At what situation are we starting the next year? And the Fed, by the way, has continuously said they know the direction of travel, but they don't know the destination. They don't know what the terminal rate will be. In fact, they've used the term, I believe some of them have used the expression, the neutral rate will reveal itself. Almost like a conjuring a religious type of connotation. So, it would be good to know what that neutral rate is, at least before a potential policy mistake, which we don't expect, but still would be good to know.
All right, we're going to leave it there. Sonia, I think you captured my sentiment just as good as anybody. Sonia Meskin, she's a U.S. economist at UBS. We wish her a happy Thanksgiving, and we'll catch up with her next month sometime, I'm sure. In the meantime, stick around. A lot more coming up on the big program, including a Bloomberg scoop that came out just a little while ago involving Uber. The FTC announcing an investigation into the ride-hailing company. We're going to take a look at what the shares are doing and exactly what the FTC wants. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. All right, it's time now for our stock of the hour. We're taking a closer look at Uber. The FTC, the Federal Trade Commission here in the U.S., we're told is investigating the Uber One subscription service following customer complaints about some of the company's practices. You see the reaction in the shares. They were down more significantly earlier in the session, now relatively unchanged. Let's get you an update here on exactly what's taking place, what the FTC is looking for, and what Uber's response is. Bloomberg reporter Natalie Long joining us right now here in Studio 2. So kind of explain this Uber One service. It's a subscription service anybody could sign up for. The FTC seems to be taking issue, not so much whether you signed up for it, but whether you want to get out of it and cancel it.
Yes. So the Uber One subscription promises some discounts on Uber's rideshare and delivery products, like free delivery on orders. And the FTC is looking into whether they have violated some consumer protection laws, specifically why it is so difficult for some consumers to cancel the subscription.
Okay, and you actually had experience with this. Is this a subscription where you pay for it, or is it free and then over time they start charging you? How does it work?
So you do definitely can pay for it on a monthly or yearly basis. Sometimes if you're a certain credit card holder like Capital One, they give out these subscriptions for free, and you can choose to link it up to your account. And I personally have a Capital One credit card, and it came with the Uber One subscription. Has
Uber responded at all to either this investigation or Bloomberg's report?
Yes, so they've denied all these allegations, but they confirmed to us that they are working with the FTC to answer any questions from their probe. And there was actually some back and forth between the two as well. FTC wanted to propose a settlement after the election, but Uber countered with another proposal. So it's still under.
So the FTC wanted to do something.
Yeah, they wanted to settle in monetary.
That's interesting, because usually we don't hear about these things until it's sort of resolved. Yeah. But this is a little bit different. Yeah.
So how important is Uber One to Uber the company, to its financials?
So Uber One is program for them to gain loyalty of their customers. About 35% of their mobility and delivery gross bookings are from their members. And so they have about 25 million of those members right now, and it's still growing.
But it gets to the question, too, of how important is it, right? I mean, if you're talking about something that basically a lot of those members probably would still be using the Uber service anyway, you kind of wonder, does Uber need this? Is there a real benefit to keeping this? If there is a regulatory overhang, we should point out, that could potentially disappear when a new administration revamps the FTC in about 2 months.
Yeah. If we look at a broader landscape, DoorDash, Lyft, and Instacart, they're all coming out with these subscription programs to lock in loyalty with their customers. So and so it makes sense for Uber to still have this product to keep their pool of customers.
You know, Natalie, you can't buy loyalty.
Some companies say they can. Uber One is also unveiling Uber is unveiling Uber One membership in India. So I'm guessing that this is a bigger thing than just the U.S. How does this play into Uber's overall ambitions beyond ride hailing, beyond food delivery?
Yeah, and so again, it's about the loyalty, and the CEO has talked about wanting to launch more exclusive events for the members, so sort of offering more value, and again, it goes back to getting more sign-ups from the customers.
Okay.
It's like their Amazon Prime.
Yeah, that'd be nice. Yeah.
But Amazon Prime serves a purpose, right? You get free shipping. You get to watch all those TV shows.
I don't know. Am I allowed to say this out loud? I'm kind of over Amazon Prime.
Really?
Yeah. So
I'm
sure I'll get in trouble for that too. But I got to be me, guys. Sorry.
Bloomberg's Natalie Lung. Thank you so much. Natalie, of course, covers Uber for us. Coming up, we're going to take you to the closing bells with Nancy Tengler. She is CEO and CIO of Laffer Tengler Investments. This is The Close on Bloomberg.
We're telling our investors to make sure that they have an allocation to commodities, oil and gold in particular. And for those investors for whom it's appropriate, alternatives like hedge funds could also be a stabilizing asset class within a portfolio.
A muted day in markets here on this Thanksgiving Eve. Romaine Bostic alongside Scarlett Fu, Tracie McMillion kicking us off to the close just about 50 minutes ago here. Scarlett, red pretty much across the screen, though we should point out the day ahead of a holiday, and I don't think there are a lot of people at their desk right now trading. Volume incredibly light.
Thin trading today, thin trading on Friday when we only have half a day of trading as well. So pretty much we're looking at...
Are you working that day?
I am not.
Oh.
I know you're doing surveillance, so you have an early start.
This is like some weird bargain I made with our boss. Like
are you regretting it now?
And I kind of forgot that I made that bargain with her, and now I feel like I should call her.
Well,
maybe she's watching.
Hopefully you're having dinner early so that you can get to bed. The weak link of today's trade, if you want to read into it at all, is big tech. And we were talking a bit about, this moving away from semiconductor companies towards software companies because they're kind of safer and more guarded from tariff fears.
Here's my promise to you. I think coming into next week, under the start of the new month with trading, I think we really need to focus on the rotation within sectors.
Yeah.
Because we talk about it kind of on a broad basis,
Big cap to small cap.
Big cap, small cap. But when you look at the individual sectors and the rotation going in within those sectors, it's pretty dramatic. It's not just in tech, but you're also seeing that in the quote-unquote cyclical space, but it's not all cyclicals participating in that
Not all
rally.
cyclicals are created equal, and that's something we'll get into for sure. We should note that yields are coming down as well, and Bitcoin is back in the green once again. Yeah,
still trying to knock on that door, of course, of that $100,000 mark. We'll see if it gets there and what, if at all, it means. Let's get some insights out of one of our favorites, Nancy Tengler, CEO, CIO, over at Laffer Tengler Investments, joining us here as we count you down to the close. Nancy, great to see you. And I don't know if I've actually spoken to you since the election, but we talk about the big rally that we've had coming out of that. And not just a rally, but really a sense of, I don't know if it's euphoria, but just certainly a sense of optimism that some of the policies, potential policies that might come into place next year should be advantageous to the market and by extension, of course, to corporate companies themselves and their bottom line. I am curious as to how much further can we go until we actually see a material change in the fundamentals, because this is a rally at this point that's just all on optimism and hope.
Yeah. Hi, Romaine. Thanks for having me. And by the way, I've been chuckling through the whole show. So
thank you.
You tanked a couple of my stock picks, so we'll talk about that later. But Yeah, I think we're at a point now where we need to see very rapid action and plans. Remember the last time that we had a Trump administration and a sweep? I remember saying multiple times that by January or by February 20th or February 15th, I was exhausted because we had so much volatility. There was rhetoric and the market would trade up or down, and then we'd see the reverse of that. So now that earnings are kind of in the bag, and we had a great earnings season for the most part, 77% beat. Average historically over the last 30 years is 67% that beat, which in and of itself is interesting because if companies are beating that much, it sort of begs the question. But I think what we now are going to be turning our attention to is the economic numbers like the ones we got today, the Fed less so than maybe we did a year ago, and what's going on in Washington. Or soon to be Washington.
Well, let's talk about the economic data. And I want to talk about it through the lens of some of your stock picks, because one thing that jumped out at me, at least with the economic data points today, the quarterly GDP update and those monthly PCE numbers, was what was still a pretty strong consumer. Consumers still spending, consumers still making more money, consumers actually saving more, believe it or not, Nancy. I mean, I would think that would be a recipe for buying retailers, apparel companies, and other type of discretionary names.
Yeah, so I think the numbers were good. I'm a little concerned and have been that inflation's stickier and higher than maybe the Fed is anticipating, which would argue for me that they skip December, but I don't think that's going to happen. But we have liked consumer discretionary in particular. We've been overweight the group for over a year. And our poster child of our investing theme is Walmart, which we've owned for many years. And because they have pivoted to all the new technology. So just juxtapose Walmart against Kohl's or Walmart against Target, and you can see dramatic outperformance because this management team has embraced every new technology, robotics, generative AI, cloud computing, the gamut. And so that's important if you're going to be an old economy company that's going to thrive and survive. We also like Home Depot, and it's in our 12 best ideas portfolio. So even though it's up a fair amount this year, we think it's poised to reaccelerate. So there's a lot of things to like, including the stock that you're over, and that is Amazon, which is also in our 12 best ideas portfolio.
All right, well, give us a quick and dirty why.
Oh, I think just the cloud computing business and the advertising business and their focus on, even with all the investment they're doing in AI, they're still generating $50 billion in free cash flow. All of these companies are going to continue to do share buybacks, and that will put a floor under the stocks, whether you like it or not. It will. And I don't like it. I'd rather see them initiate or increase dividends, but we get there all sorts of different ways.
Yeah, and it's so expected at this point, right? So, Nancy, as an investor, I'm curious, how much do you plan to rely on the rollout of the Trump economic agenda from 2017? Tariffs, deregulation, tax cuts, to determine how to position your portfolio in 2025, when in fact you've got a very different macro backdrop.
Yeah. For sure, Scarlett. And I think, what you saw in the numbers today was that capital goods those numbers were disappointing. Non-defense capital goods, negative 0.2% versus an estimate of 0.1. And then the September number was revised down pretty dramatically. We have seen that trend since the 100% expensing that was facilitated by the Tax Cut Job Act has declined. I think next year will be at 20% minus any, or maybe that's 2026. But the numbers are much lower, and so companies have less incentive to invest in technology and capital goods and more incentive to buy back their shares. We're overweight industrials. We do think that we'll see that shift and be reignited in a new Trump administration. Deregulation is hard to quantify, but super important to the larger companies, like what we saw today with the Uber news, my other stock pick for today.
All right, Nancy, great stuff. And I apologize, we need to let you go. We have some breaking news. Nancy Tengler, the CEO and CIO over at Laffer Tengler Investments, counting us down to the close. A redhead crossing the Bloomberg terminal right now on Microsoft. The U.S. antitrust watchdog, the FTC, has sent detailed information, a demand to Microsoft, launching a broad investigation into some of that company's business practices. These questions focus largely on software licensing, cybersecurity, and AI. We're going to get you some more details on that that as we move closer to the closing bells. Microsoft hitting session lows. The stock's basically unchanged on the day. A full breakdown of all your market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlet Food, taking you through the closing bell, a global simulcast. It starts right now. Carol Masser and Tim Stenovic in the radio booth. Alex Steele has the day off as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. And Carol, before we get started, I just want to reiterate some breaking news that just crossed the Bloomberg terminal. Microsoft has been sent a list of questions by the FTC, one of the main antitrust watchdogs here in the U.S., involving the company's software licensing, cybersecurity, and AI practices that did send the shares down to session lows.
Yeah, they say after more than a year of conducting informal interviews with competitors and business partners, antitrust enforcers have crafted a detailed request to force Microsoft to turn over information. According to those familiar, the demand, which is hundreds of pages long, has been sent to the company after FTC Chair Lina Khan signed off, said one of the individuals in the know. And as you said, shares of Microsoft, we know the big tech mega cap space has been lowered today, but right now we've got Microsoft hovering near its lows of the session, down about 1.2%.
Yeah, those antitrust lawyers over at the FTC are set to meet with Microsoft competitors next week to actually get more information about the company's business practices. This is according to two other people familiar with the plans who, like the others, asked not to be named, discussing a confidential matter. Microsoft and the FTC did decline to comment.
The one weird thing about this, though, is I do wonder, why do something like this when basically everyone involved in sending this letter is probably not going to have a job in 2 months?
Just wondering the same thing.
That's a good question.
I don't know. I mean,
a message?
It could be performative. We were talking with one of the Bloomberg reporters, said that this investigation has been a long time coming, so maybe it just took some time to get to this point. Nevertheless, a lot of questions that need to be answered as we get the closing bells here on this Wednesday afternoon. Light trading ahead of the Thanksgiving Day holiday, with the Salvation Army, good for them, ringing the bell over at the NYSE. The Dow Jones Industrial Average lower by more than 100 points, or about 0.3%. The S&P down about 0.4%. The NASDAQ Composite is going to close out the day lower by 0.6%. You see the theme going here. The one index that is trying to buck that's the Russell 2000, actually going to finish the day slightly in the green, higher by 2 points, or just about 0.1%.
Yeah, that Russell continuing to outperform the S&P 500 since the election. In terms of the S&P 500, though, the big caps, kind of an even split, Scarlett. 269 names actually gaining ground on this Wednesday. 231 to the downside, 3 unchanged.
Yeah, but more sectors are in the red than in the green. We're going to start with tech, of course, the biggest decliner among industry groups, losing 1.2%. And that, of course, is a huge slice of the pie because of its weighting. Consumer discretionary also lower by 0.7%. And industrial. So some of those cyclicals coming into play as well. On the flip side, real estate investment trusts, healthcare, and financials are doing better. So even as people have been rotating into cyclicals, there's certainly a discerning between the different sectors within the cyclical group.
All right, guys, maybe I had too much time on my hand, but my list of gainers today, an homage to the one and only and always dapperly dressed Romaine Bostic, because the list is like a shopping day for him. So we're going to start with Urban Outfitters.
You shop at Urban Outfitters?
I'd like to see Romaine.
I'll plead the fifth.
Urban Outfitters.
All right. Well, we're going to start there. That stock's up 18%.
I did go in there once.
There you go.
Maybe even twice, perhaps.
Yeah, I felt old.
All right. Well, you kind of are old, but all right. No, I'm just kidding. No, seasoned is what I would say. Urban Outfitters up 18%, up the most intraday in more than 4 years. Really a big pop here. Home to Anthropologies, Urban Outfitters, Free People, Newly Brands reported stronger than expected sales growth in the third quarter, led by their Anthropology brand. It suggests that Urban Outfitters may be faring better than some of the other apparel retailers.
Oh wait, I've been to Anthropology. I forgot. Yeah.
I know, that's a really
I actually liked some. I got a couple of pieces of furniture from them.
See?
Yeah,
okay.
and one of those frilly dresses.
You know, I could see that. No, maybe not. But and there's nothing wrong with that. I'm just going to say. Anyway, so upbeat in that one. All right, let's continue with the Romaine shopping trip, because maybe we stop at Ulta Beauty, because that one also up about 4% in today's session. D.A. Davidson saying that competitive pressures on the cosmetics retailer are, quote, showing some signs of alleviation. Apparently there's been some concern a little bit more generally in the space. The analyst there notes that slowing industry trends and competition have weighed on Ulta's comparable sales. So maybe they're not. We shouldn't be so worried. Is basically the message. And then as we finish up the shopping trip for Romaine, Foot Locker up 3.4% today. Williams Trading raised the company to hold from sell, saying that its improved assortment of products from brands like New Balance and others offering to maybe do enough to offset diminishing Nike allocations in the near term. So anyway, those were your three gainers.
Okay, I got the decliners. The theme around my decliners, not about shopping, it's about earnings. That's why they're all moving. Starting with shares of Dell, down more than 12% today. This after the company reported revenue in the most recent quarter that missed the average analyst estimate. We also saw HP Inc. report quarterly financial results indicating that a recovery of the PC market is stalling. We talked to Woo Jin Ho over at Bloomberg Intelligence, and I asked him, hey, isn't Dell an AI play these days? And he said, yeah, he's kind of scratching his head as to why investors are overlooking the AI momentum that we learned from Dell yesterday. The stock's done really well so far year to date, but this today down more than 12%. CrowdStrike fell after the company issued a weaker than expected earnings forecast. Investors were disappointed because they've been watching for signs that it's recovered from that flawed update that crashed computers around the world. You remember what happened over the summer? Millions of devices operating on Windows crashed as a result of that flawed CrowdStrike update. Remember what happened over at Delta. The company did post signs 3 months ago that beat expectations, a sign that investors took to mean that the IT outage that was global in nature would not significantly affect its finances. CrowdStrike shares fell by about 4.6% today. And finally, Nordstrom shares falling on third quarter results. The company did raise the lower end of its annual sales guidance after its off-price and flagship chains reported quarterly sales growth that was better than expected. Shares down today by about a little over 8%, Romaine.
Yeah, interesting. I was kind of curious about why we saw such a big move lower on Dell, down 12% on the day. It kind of had me scratching my head as well, but maybe the way that it run up contributed partly to that. Let's check in on the yield space here. A somewhat muted day there with yields moving lower across the curve, roughly down about 3 to 4 basis points on the 2-year curve. Your benchmark 10-year yield moving down by about 6 basis points and 5 basis points on the 30-year yield here. But then when you look at the yield curve in totality, the 210s, pretty much where we've been now for the last couple of days. 210s right now sitting right around about 2.3 and with a positive sign.
All right, so as we get ready for the Thanksgiving holiday, folks, certainly here in the New York metro area, get ready for a wet one. The Thanksgiving Day parade is going to be maybe a little messy this year. I know. It's. I've been.
It's our tradition every year. We go out every morning.
Do you really?
Yeah, we get up early and go out there. We go rain or shine, by the way. So
now you need to bring your umbrellas and your raincoats.
Yeah. There's like this fast-moving storm along the Northeast, and so they're saying northern New Jersey, you're looking for maybe an inch of rain. New York, Boston, early Thursday morning, and then heavier rain.
So this is real rain. This isn't just a drizzle.
This isn't just a drizzle.
But we need it, though.
Well, maybe it'll thin out the crowds.
We need it. We need the rain here. 97% of the Northeast has been abnormally dry. More than half of it is actually in drought. So the storm that we could get tomorrow should tamp down the risk of those brush fires that we've seen over the last month that could ease pressure on the upstate reservoirs that provide New York City with drinking water. I can't believe we're actually talking about this in the Northeast. Like, I'm from California. Drought, is a fact of life. But yeah, this is not great here.
Yeah, riveting. What's your favorite balloon, Tim?
What's my favorite what?
What's your favorite balloon?
Balloon?
Yeah.
A Bluey balloon. It has to be Bluey. Is there a Bluey balloon?
Yes. Yeah. He was there last year.
Okay. Yeah, Bluey.
What's your favorite?
Have you never taken the kids to the...
Carol, this is like they're not gonna. I'm not gonna introduce them to.
Right now they're blowing up balloons. It's so much fun.
Yeah.
Tim's like, they don't need to know about this.
They don't need to know about this?
It's like Disneyland. They don't need to know about it.
They don't need to know it exists until they do.
I'm going to write them a little
It's a need-to-know basis with this stuff, okay?
Okay, interesting.
Yeah.
You parent your way.
Tim, depriving his kids of joy and fun.
You do you, Tim.
Yep,
Exactly.
that's how we roll.
There's something else this Thanksgiving which is curious, which we've talked about this a number of times. Turkey prices are lower. Yeah. They're the same where they're lower, and Stu Leonard's was telling us this yesterday. But what's interesting as well is that...
he told us about a lot of his deals.
Yes, he did. But the supply of turkey is also lower, too.
You had fun. It looks like you guys had fun.
It was a lot of fun. He was very proud of the romaine lettuce in particular.
Of course.
Selling out.
Yes, exactly. No, but with lower turkey prices, there's also lower supply. So usually it doesn't work like that, right? I mean, usually when there's lower supply, the turkey prices go up. But all it does is really show that there's not a whole lot of demand for turkeys this holiday. Are people eating something else?
But isn't that like, I feel like we have this conversation every year. It's like, who buys a whole turkey any other time other than what?
Yeah.
Thanksgiving,
That's
Christmas,
kind-
maybe
that's
Easter.
kind of a hot take,
So
right?
there should be higher prices for turkey, given that supplies are.
But I thought Stu's thing was right. He talks about the idea of where the aggregate demand is, and the idea here is that those prices don't fluctuate as much. And also, they were saying that the producers have a lot more time to react to their own cost pressures because it is a bit more of a seasonal item.
Well, I was asking the question because we often have hot pot or shabu shabu instead of turkey for Thanksgiving. We just don't even do the turkey thing.
That sounds great. I'm coming over.
Sacrilegious.
Wow, no, you gotta do turkey.
Coming over.
I know.
Yeah.
Well, now we do both. Now we do turkey
Eat
and
a
hot
leg,
pot, so.
gotta be able to eat it the next morning.
I'm with you.
Oh yeah,
I know.
constant eating on
Tradition.
Friday, right?
So Scarlett and Tim, you do you.
I know. Yeah.
Wayne and I
They're
will
definitely
do us.
non-traditionalists when it comes to the holiday, but it's fine. It's America.
All right, guys.
The parade doesn't exist. We don't eat turkey.
Leftovers are my favorite. That's like my favorite thing. Have a good and safe weekend, everybody, and be careful with the weather out there. Happy Thanksgiving. Much love, much love. Some of us are going to be here on Friday. Some of us will not. So we'll be back, though, again, I think, as a team.
Monday, let's say Monday.
On Monday.
Yeah.
Let's get back. All right, everybody. Thanks for joining us on The Closing Bell.
And we continue our coverage right here on Bloomberg Television. For those of you who are still watching, coming up, we are going to talk about the Thanksgiving Day holiday, travel, retail, and we're also going to talk about things a little bit more serious. Your child's college dorm room. It's a little bit outdated, and apparently that Republican sweep in Congress could, make things a little bit worse. We're going to explain in our Muni Moment that's coming up in just a bit, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
I'm Romaine Bostic. We talk about light trading here ahead of the Thanksgiving Day holiday. Remember, Friday, basically a half day for the market. So this is basically the last full trading day for the month of November. Stocks higher on a monthly basis across the board, but you saw a lot of weakness heading into the final few days of the month. The S&P 500, which was on a 7-day rally, that rally ends today, down only about 0.4%, back below that 6,000 level, though we should point out on a technical basis, the uptrend still very much intact. Not so much when it comes to the Mag 7. You saw a significant drop on the day and on the week here, though we should point out the Mag 7, barring a huge drawdown on Friday, is likely to finish the month of November up by about 7%. In fact, one of its best months, I think, of the year here, though on a technical level, the downtrend there is slightly to the downside. Bitcoin up once again by 5%. And your 2-year yield there, Scarlett, back down to 4.2 and change.
All right, let's take a look at some individual movers as well. We're going to start with HPQ and Dell because both of these are old school tech companies. They fell after weak results. Their PC businesses in particular saw declines or missed analyst estimates. And then you mentioned Bitcoin. You have the Bitcoin adjacent companies, crypto companies climbing as Bitcoin resumed its rise, making that run for $100,000 again. MicroStrategy, of course, has become the
What
proxy.
happens when it hits $100,000? Did we win something?
No, we talked about how $105,000 is the next level that everyone's watching for. We also just want to mention Microsoft very quickly because there was news there over the last 15 minutes or so that broke, and that is that the U.S. antitrust watchdog, the FTC, has opened an investigation into the company. It's looking into the cloud computing business, software licensing business, cybersecurity offerings, and AI products. They want detailed information from the company. The big question mark is how much of this can actually take place, how much will get done before a change in administration. No word yet on whether Lina Khan will stay or go. All right.
What? Did you say no word?
Not really, because
you think Trump's keeping Lina Khan
J.D.
around?
Vance did say that he was a fan of hers. I know. I'm just going with what J.D. Vance has said. Until there's an official word, right?
I know.
All right, let's go on to our top
Next, you're going
story.
to tell me Santa Claus isn't real.
All right, let's go to our top story this hour, which is consumer spending to the rescue again. The latest read of the U.S. economy shows a 2.8% growth rate in the third quarter on an annualized basis, driven by what else? Consumer spending, which rose 3.5%. That is the most this year. Now, the question is how much of the spending might have been pulled forward as inflation-weary shoppers stocked up on deals months before the holiday season. Hint, hint, Roman Bostic.
Who did
that?
Oh.
We'll dig into the spending intent of different categories of the consumer later in the program.
All right, I am looking forward to talking about that. Before we get to that, we want to have our Muni Moment now. Interesting story out there about a group of states led by Texas suing BlackRock, Vanguard, and State Street, Wall Street Titans. The concern, Texas and those states saying that those companies allegedly violated antitrust law, claiming that the investment companies boosted electricity prices through their investments in coal companies. Peter Jeffrey is Bloomberg News legal editor, and he joins us here in Studio 2 to kind of explain what's going on. I feel like this is part of that long-running battle that we've seen between some of these states that took issue with some of the ESG initiatives that these companies either were pursuing or maybe not pursuing. I don't understand this lawsuit, though. Explain to me exactly what the beef is with their investments in coal.
Texas and the other states say that these giant money managers, by holding positions in so many coal companies across the country and pursuing a green agenda to reduce coal emissions, have basically created a kind of cartel whereby they wind up pushing down coal output, raising the price of coal, benefiting from that through the increase in the company's value in their portfolio. And the states, Ken Paxton in Texas and the other Republican-led states, are basically saying this breaks antitrust law.
Okay, I get that now.
Yeah.
That also sounds like a conspiracy theory. Is there evidence? Is there evidence that this is what they're doing and that's intentional?
The evidence in the lawsuit that the attorneys general put forward is that these are the holdings, these are their actions in the green initiatives, and the result is higher electricity prices because of lower coal output. What they do is they point to the 1914 Clayton Antitrust Act, which says...
an oldie but a goodie.
Which says that if you as a company or as an investor gather together under your umbrella enough companies in the same industry and the effect is anti-competitive, you have broken antitrust law.
The effect is anti-competitive. In this case, they're accusing these firms of pushing or combining to lower prices on coal?
No, combining to cut the coal output, which then raises prices for consumers.
Got it.
And that's why there are so many states involved here.
But it's not direct, though. It's indirect.
Yes, it's indirect. And the reason it's not just Texas, but all these other states, is that they're saying that consumers across these other red states are paying higher electricity prices because of this effective cartel. And as Romaine said, it's really interesting because it comes in the context of all of this pushback to ESG.
Yep.
The actors here were looking and studying BlackRock and State Street and Vanguard for quite a while now, more than a year or two. This summer, a House committee, Republican House committee, said that for the first time, said this is antitrust. We hadn't yet seen a lawsuit, though, based on antitrust grounds. This is the first one. So it really marks a very high-profile event in the litigation. Can the states show that it's the activities of the big money managers in fighting climate change that has caused coal output to go down, or coal output went down independently? It's been shrinking anyway. In Texas, it was just 10% this year of Texas's output. Just 4 years ago, it was 18%. So it seems to me if you're fighting this lawsuit, if you're the money managers, you're going to say, well, there's no cause and effect there. And in fact, BlackRock did respond by saying, what this suit is claiming that we are colluding to hurt the very companies we hold in our portfolios. How does that make sense?
Right.
So it might be an uphill climb for this litigation.
All right, Peter, really, really fascinating lawsuit here. Peter Jeffrey over at Bloomberg's legal team. Thank you so much.
Pleasure.
All right, as states clamp down on those ESG practices, the federal government could be clamping down on a different area of the muni market, and that is tax-free university bonds. The Republican sweep in the November U.S. election is threatening a niche tax break that helps American colleges upgrade their campuses, well, at a cheaper rate. Joining us now is Chuck Samuels. He is a Mintz Levin counsel to state bond issuing authorities for nonprofits. Good to speak with you. I guess the first question here I'd have to ask is, give us a sense of the scale of things, Chuck. How many universities, nonprofit schools, colleges, universities, or private schools are able to sell these tax-free bonds for something like upgrading their facilities?
Thank you for having me on. Thousands of colleges and universities, including very small ones, technical schools, career academies, are able in a variety of ways to access the market at reasonable prices through tax-exempt bonds. Of course, there are very large universities, public and private, who use that marketplace as well, but it is very widespread.
And the fear here is that the federal government will try to close this tax break remove it because they need to raise funds for the other items on their economic agenda. You work as a counsel to the National Association of Health and Educational Facilities Finance Authorities. What's the response from that group?
We believe that it makes no sense to place a burden on the cost of higher education in order to pay for other, even very important tax priorities. We also disagree with any notion that some of the social policy and political controversies between academia and the government or even the greater community should be the basis for retaliation through restrictions on the use of tax-exempt bonds for higher education. We think those things should be totally separated out. We have an existing system that supports the greatest university system nationwide in the world, the envy of the world, and we would not want to undermine that and make it much more difficult and expensive, particularly for smaller institutions, to be able to improve their physical plant and their equipment and provide a better environment for their students.
Chuck, I am curious, though. I mean, what is the likelihood that this change would actually even happen? I mean, my general understanding of the legislative process to sort of change something like this, it just doesn't seem like whatever rhetoric's coming out of Washington, it doesn't seem like they would have the votes for this, or do they?
Well, one would hope not, but we have to take into account that in 2017, legislation even broader than this was passed by the House of Representatives, but fortunately was stopped in the Senate. Second, many of the conservative think tanks and the papers that they always develop for the new administration have proposed very broad restrictions on tax-exempt bonds. So we certainly hope that we're not going to see these type of proposals, but the community, the municipal finance community and the higher education community need to be prepared for the debate.
I am curious, Chuck. I know it's your job to sort of make sure that this doesn't happen, but let's say we do get a rescission of these tax-exempt allowabilities for these bonds here. What then becomes of the industry? What then becomes of some of these municipalities? Do they have other options?
In many cases, smaller, less creditworthy institutions, and if it applies to governments will have to defer very important expenditures, and in other cases, they will become much more debt and cost burdened. And this is in the face of a major thrust of the new administration, which will be to support reshoring in the United States, which requires exactly the infrastructure, both in the private sector and the public sector, that tax-exempt financing facilitates.
All right, Chuck, great stuff, and really appreciate you taking time to be with us today. Here for our Muni Moment, Chuck Samuels, the Mintz Levin Counsel to State Bond Issuing Authorities for Nonprofits. A closer look at some of the rhetoric coming out of Washington that could potentially, maybe, get rid of that tax-exempt status for several municipal bonds. All right, when we come back, Scarlett, what do Marie Le Pen, Jamieson Greer, and Don Wilson all have in common?
Our top three is next.
Our top three is next. Movers and shakers at the center of the day's biggest stories. That's coming up after the break. Stick with us. This is Bloomberg.
Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Don Wilson. He is the founder of the world's biggest trading firm, DRW Holdings, one of them at least. And he says it's time to rethink the entire U.S. securities industry framework. He says the friction between the SEC and CFTC is counterproductive. Burn it down to the ground, get rid of both of them, remain, and create an entirely new regulator.
I love this. This was one of the first stories I read on the Bloomberg terminal when I got up today. And my first thought was, okay, guy who's been investigated by these regulators for years is against these regulators. And
surprise,
it's like, okay, surprise, surprise. But then the question really becomes like, the practical question is, what do you replace it with, right?
Exactly.
I mean, it's easy to quibble with the SEC and CFTC. Look, we can have that debate at some other point. But he didn't actually seem to articulate exactly what that'd be. Just we need some new super regulator for new times. You know, I guess that's something we should be talking about.
That's pro-crypto, by the way.
Good for him. You know who I'm keeping an eye on? Jamison Greer. Do you remember him? He was
involved the first time around in the first Trump administration.
That is correct. He is Donald Trump's pick to be U.S. Trade Representative, and he was in the previous Trump administration as the Chief of Staff to Robert Lighthizer, who was, of course, the Trade Representative during the first Trump administration. This is an interesting pick. I mean, he is a quote-unquote China hawk, which isn't a surprise given who Lighthizer was and given who Trump is. But there's a lot of speculation here as to how he's going to lead this agency at a time where Trump is threatening to raise those already high tariffs on China even further.
Absolutely. So someone to keep and watch out for. And of course, third on the docket is Marine Le Pen. She's the leader of France's far-right party.
Is she in the administration too?
No, she's not. But she's going to find out in late March whether she is allowed to run in France's next presidential race. So what happened here is that the embezzlement trial of Le Pen and her National Rally Party wrapped up today. And the prosecution recommended that she be convicted of misappropriating funds. And they want her to be banned from public office for 5 years, which would take her out of the 2027 race.
All right. Well, something to keep an eye on there over in France. Meanwhile, back here in the U.S., the Transportation Services Administration predicting this may be the busiest Thanksgiving travel period on record. When we come back, a conversation with the CEO of the travel site, Kayak. This is Bloomberg. This is the countdown to the close. Romaine Bostick alongside Scarlett Fu. You're taking a look at a live shot there of Central Park West in New York City, where they're blowing up the balloons, Scarlett, for the Macy's Thanksgiving Day Parade. I can't tell what those two balloons are actually doing, but at some point they will be lofted into the sky, of course, tethered by people walking down. Do you go to the parade, Thanksgiving Day Parade?
I do not. I watch it on TV because I just can't be in the crowd like that, but the disappointing thing is that it's going to rain tomorrow. It's going to rain a lot.
So it's our tradition to always go to the parade in the morning. It might be favorable. It's supposed to be 50 degrees, which for Thanksgiving I'll take. But they say only a 50% chance of rain, which when you look at these weather apps, 50% might as well be zero. You never know. I mean, that's basically a coin flip. So we're going to take our chances.
But we also heard there's going to be 1 inch of rain, so it's not like a drizzle, but like actual hard rain.
Yeah. Well, okay. Well, we're going to take our chance. You have to sacrifice for tradition.
Well, good luck to you.
Maybe that thins out the crowds.
Yeah, and then you can enjoy the Pillsbury Doughboy or what Santa Claus or whoever was there. All right, let's move on because top federal officials. We're going to talk about travel.
Okay.
Yeah, top federal officials are projecting the busiest holiday travel season yet. So the TSA is expecting to screen 18.3 million people from November 26th, that was yesterday, to December 2nd. That is up 6% from last year. Joining us now to share with us what travel trends he is seeing is Steve Hafner. He is CEO of Kayak. Steve, it's good to speak with you. Just walk us through again the busiest travel days of this season, because once upon a time it used to be people all left on Wednesday or Thursday, then they had to rush back by Sunday night to get to work on Monday. But then, remote work, hybrid work kind of changed that changed that up quite a bit, in fact.
Yeah, look, historically, the Wednesday before Thanksgiving is the absolute busiest day for this holiday period. That lessened a bit during COVID when people had more flexibility around their travel planning because of, remote work conditions. But we're back to normal trends. So this is the absolute worst day to travel on if you don't like crowds in airports. But if you want to avoid that, you can still travel tomorrow morning and you'll have a much better experience. That said, cancellations this year, the storm we expected last week to roll through is not snow. It's warmer, as you mentioned earlier, so it's rain, and airlines can fly through that just fine.
So we're showing a graphic of the busiest airports during Thanksgiving weekend. LA, SFO, Boston, Miami. These are all international airports. What does that say about where people are going?
So, most people are traveling domestically during this period to go see friends and family, but there is a surge in search interest on Kayak for international destinations over the remainder of the holiday season. So I'm talking about Christmas and New Year's. So over 70% of our queries now are for those places. And it's remarkable to see because the average U.S. airfare domestically is almost $500. International is $1,300. So it's a big increase in price points for consumers who are, I think, still a little bit uncertain economically.
Yeah, I am curious about that. And I mean, even though the TSA, for a lot of us, of course, this is kind of essential travel. We don't really have much choice but to go see our families here. And I know the TSA is predicting of record levels. But it gets to this idea. Have you seen some of your customers, some of the folks who use your platform, be a little bit more choosy in either picking flights or maybe just deciding not to go at all?
Well, for sure. And the biggest indicator of that is not the full planes, because planes these days are almost always full. It's what people pay to get on them. And the average fare in the U.S. is 6% lower this year than it was last year. So that tells me that consumers are pulling back a little bit. They need to be enticed to get on airplanes. The average international fare is down almost 10% versus last year. So, travel demand is softer than it was over the last 3 years.
Yeah.
But these are still relatively high price points, so people still do want to travel.
I am curious about how the airlines are going to handle this crush of people. I travel a lot. Earlier this year, I ended up in a lot of delays for a variety of reasons, some of which had nothing to do with rain or the weather at all. Some of it's just volume. And so this is one of the biggest days of the year, probably this and the Christmas holiday. How prepared are the airlines to handle that crush of people and the airports?
Yeah, you're exactly right. The volume of travelers actually is the biggest causative factor in terms of flight cancellations and delays. But the holiday period, despite a popular myth or belief that it's high volume, summer is actually the worst time to travel. So if you look at around the July 4th holidays, stretching into early August, you get on average 3.3 million people, so 10% more than what we're experiencing today. And that's also when you get the worst storm systems in terms of flight delays. So for those of you who want to travel in the holiday season, don't be afraid to do so. The airlines are very good at managing their operations, crew scheduling, airport or airplane redundancy. The airports are staffed up at TSA. And even air traffic controllers, where there is a staffing shortage, that's mainly on the East Coast, and they're taking care of that as well. So knock on wood, it's been a very, very smooth flying day. Tomorrow and the rest of the week should be even better.
Yeah, but it's always the anticipation that something's going to go wrong. And that comes up when you're actually buying the ticket and you're asked whether you want to buy insurance to cover whatever contingencies may arise. What does that look like? I know people are trying to cut back on some of the extra spending around the main item that they were looking to purchase. Are a lot more people declining the insurance than they used to?
It's hard for me to have data on that because at Kayak, we don't actually see the actual purchase. But I will tell you that the biggest surge in our query volumes is for premium seats. So premium economy is up 31% year over year. Business class is up 22% year over year, which tells me people are willing to spend for a better experience. And certainly if you look at airline performance, United and Delta, who are the most adept at upselling, now consume about 80% of industry profits or produce 80% of industry profits. So I think people are choosing when they do travel to travel in style and in comfort. And, I suspect that extends to insurance products too. Gives you peace of mind.
Also, paying for premium economy also gets you some of the basics that you didn't used to have to pay for, which is being able to bring your your carry-on luggage on board. If you end up in the super economy seats, by the time it's time for you to board, they're forcing you to check in your bag at the gate, which has been a source of frustration. And I imagine creating delays for flights too.
That's right. Although, I know a lot of people who hope that they get at the back of the plane and they get a free checked bag instead of having to pay for it on the front side. But I think the observation that it's a lot harder to do an apples to apples comparison of flights today is absolutely true, because there's the price of the seat, then there's the check-in process. Where are you in the priority? Can you bring a carry-on? Can you bring a checked bag? What's the in-airport experience like? These are all things the airlines are getting much better at slicing and dicing and bundling, which makes it even more much harder for consumers to actually compare prices across the airlines and across fare types.
I am curious, Steve, as we kind of push ahead to the Christmas season and even beyond that, as a lot of people make travel plans that maybe are a little bit more discretionary, if you will, and not just because I have to go see mom and grandma, but it gets to this idea of where people want to go. I feel like, half the people in this office just got back from Iceland for some reason. I don't know. Where are people sort of going, or at least what are they looking for and saying, okay, this is going to be in my next big trip next year?
Yeah, so Romain, it's funny. There's those destinations you have to go to, whether it's business trips or to see family. And then there's those destinations you aspire to go to. And what we see very clearly in the numbers is the latter, the inspirational stuff, is very driven by social media. So when you talk about Iceland, that has all been fueled by social media. And if you look at kayak travel trends right now, what are the hot destinations? It's, yes, New York and Paris and London and Cancun, those are all still very popular. But the top trending destination for us is actually Japan. So it's Osaka, it's Tokyo, and I think that what's driving that is the word has gotten out that winter sports in Japan are really awesome, and airfares to Japan are cheaper than they've been in 3 years, and it's a great exchange rate too. So that's why we see so much search interest there.
Yeah, absolutely. And I know some, just personally, quite a few people that have either already been there this year or making plans to go over the next few months. Steve, going to have to leave it there. I don't know if you're traveling, but if you are, have a safe one and definitely have a happy Thanksgiving. Steve Hafner there, the CEO of the travel booking site Kayak.
The only problem with flying to Japan, at least from here, it's an 18-hour flight. So, and you lose a day when you get there.
Yeah,
but the snow is incredible.
Yeah, I mean, that's a big part of the reason why I don't travel to Asia much, because, it's like, honestly, you travel to South America and you're like, what, 9 hours? And I'm not doing that. And then you
double that.
Get that. But at some point, I got to make my way over to that part of the country.
Well,
do you think our boss is going to let us off for more than like a week at a time?
That's the big question.
Because that's usually kind of the deal breaker here.
I know. When you go to Asia, you need at least 2 weeks, because if you go for just 1 week, you get over jet lag and it's time to come home. Doesn't work.
I know. Yeah.
All right, let's give you a wrap up of how markets closed on the day. And I know it's not for the week, but it kind of feels like it, because Friday will be a half day of trading.
Yeah, it's over.
It's over. Yeah. The S&P 500 also ended its 7-day rally, so that rally's over, at least for now. We had a big data dump. Inflation accelerated, but it was within expectations. Tech was a weak link here, with the NASDAQ 100 down 0.9%. 6 of the 7 Mag 7 names closed down. Yields are coming down a bit. 7-year note auction was fairly decent. And the Bloomberg Dollar Index showing a weaker dollar right now, but everyone's talking about the strong dollar, including what we just talked about with the CEO of Kayak, people going to Japan to celebrate and enjoy that strong dollar.
It'll be interesting to see with the price action picking up and everyone coming back on Monday after the break, because there's a big slew of economic data they're going to have to parse, and of course everyone has to start looking ahead to that next Fed meeting, Scarlett. Fed speak, you love it.
Again, always.
This is The Close on Bloomberg. The days of standing outside at the crack of dawn at your local shopping mall the day after Thanksgiving, well, maybe that's behind us. The spirit, though, and the purpose of Black Friday is alive and well. This Black Friday weekend, which includes Cyber Monday, expected to rake in $75 billion, according to research from Bain Company. Joining us right now is Karen Harris, partner and managing director of Macro Trends Group at Bain Company. Great to see you, Karen. And I want to just start off first with your numbers for Black Friday weekend, or the Black Friday weekend, whatever we're calling it.
Black Friday, Cyber Monday.
But it kind of, we'd be remiss in not pointing out that a lot of these sales and discounts started days and in some cases weeks ago. So the shopping, the impetus, I guess, to try to get people to shop, that's been in effect for a while now, right?
It's true, although we do expect 8% of the total spend for the season to happen over these next few days.
Oh, wow.
So it is a pretty important chunk of the season, partly because Thanksgiving is so late. So it's a pretty compressed.
So that's the $75 billion just over these next few days?
That's right.
Wow. So give me a sense here of how that compares to previous years, because there's been a lot of talk about the consumer maybe being a little bit more challenged, maybe being a little bit more discerning. Their credit card balances are higher. How is that going to affect the numbers?
Right. Well, it's going to be a record total number, but of course that's growth. The growth is it's positive. It's going to look like 3%. We're estimating over this year at Bain, but that's compared to 4.2% last year of growth over the holiday season. So it is a little more muted. And I think what really strikes us is that so much of that depends on the upper income households that spend 54% of the discretionary income versus the other sectors of the economy.
So the earnings reports that we've been getting show clearly that the lower income consumer is challenged, is struggling, and is really seeking value where he or she can. How does that show up in the consumer health indexes that you compile and that really indicate what the trends are? Is it all the pressures on the lower income consumer, and the higher income consumer is just going ahead and spending all they want?
What we've seen is that actually there are 3 distinct types of households in the U.S. There's the lower income households that really live off their income. And when we look at their behavior, we ask them only about their income, intent to spend, intent to borrow. We found that other surveys are great for policy and outlook, but businesses only care about what their customers know that they are going to do, not what they think the stock stock market's going to do, for example. So that lower income that lower set of households depends on income. The middle group, which has been the least healthy actually over this past year, depend on housing. That's their primary asset. So when housing prices are looking muted and the market's looking tough, their sentiment goes down. And that upper income group really focuses on their portfolio. That's their top asset. So as we've seen stock markets do well, they've had a positive outlook. We've seen that lower income bracket also feeling relatively positive, not as positive as the top group, but more positive than in the past. And it's really that middle income group that makes us a little cautious.
So how would you advise retailers, who might be mindful of this, to then cater to those customers who are feeling maybe a little bit more cautious or are ready to spend the income that they have earned?
Right. Well, for retailers, I think certainly for that upper income group, that 54% of spend, while they're looking positive, if they were a stock, we'd say they're priced to perfection. That as long as equity markets hold up and nothing goes wrong, things look solid. But we've seen that beneath the surface, a lot of the sub-indexes look a little shaky. We've looked at discretionary spend, for example, at restaurants, which has been shrinking for 12 months. And that tends to be a pretty quintessential discretionary spend. A lot of the other service indicators are positive, but they're things like healthcare.
Well, that's what I'm curious about, too, because when we talk about spending, we kind of talk about it in aggregate. And I do wonder if we are seeing more trade-offs, meaning, at least particularly on those discretionary items. I'm not talking about trade-offs discretionary to staples. The idea that if you can't afford it all, you're still going to spend, but you're going to be more targeted in that spending.
I think that's right. I mean, when Bain and Dynata partnered to create this survey, we really did try to dig into, are people going to borrow more to try to make up for the behavior, for income that they don't have, or are they feeling on more solid footing? But certainly there'll be trade-offs. And of course, as people expect changes in policy that might, their perceptions of what inflation might be, that might change behavior too over this next few months.
Is there any sense here in the data that you guys are gathering and parsing that the spend that we see this holiday season could actually create additional momentum for consumer spending post-holiday season, or is that not how it works?
We're not seeing signs that things are increasingly positive, except again with that upper income group, which is the majority of spend. So if equity markets continue to boom ahead, and if the economy looks up, that optimism will stay in place. But it's based, again, on a pretty fragile set of premises. So that's not to say we can't have that great outcome, but it's certainly not locked in at this point.
Yeah, it's a reminder that the aggregate numbers mask a lot of differences when you dig beneath the surface. Karen, really appreciate your joining us today. Karen Harris is with Bain and Company. And of course, retailers not the only companies offering up Black Friday sales. Streaming services like Hulu, Disney Plus, and Max, they're also pitching holiday discounts to attract new customers and the so-called stream hoppers that binge and then quickly move on to the next service. Joining us now is Bloomberg's Hannah Miller. So streaming services are clearly on sale this Black Friday, and I guess part of this is to counter recent price increases because we report every earnings season that Disney or HBO Max is hiking prices yet again.
Yeah, a lot of companies had price increases that kicked in over the summer and in the fall. So, they're trying to balance. They're trying to still get new customers on board. We know these legacy media companies are pivoting to streaming. They're zeroing in on their services, and they're bragging about the profits and subscribers they gain every quarter.
I am curious, though, does this create a more loyal consumer, or does it not matter to them? Are they fine with that churn? Because I always thought, particularly on the Netflix side, that they were trying to reduce that churn.
I mean, the hope is always that the consumer will enjoy what they're watching and that they'll stick with the service, or that they'll just forget to cancel.
Well, that's the forget thing. We were talking about Amazon Prime earlier, and you kind of just pay it because you kind of forget about it.
That's how they get you.
And it's $100-something a year, so it's it's small enough where you just kind of like whatever.
Yeah, but they're hoping that they'll keep enough customers that it'll outweigh the ones that they lose. And we've just again seen this focus on streaming, seen this pivot to their services.
So most of these streamers are pushing the ad-supported services too, right? Because that's where they can monetize more than the ad-free premium product.
Yeah, with most of these deals, if you want to save, you're going to have to sit through ads. There's an exception here and there, but they're really pushing these ad-supported services. And that's a way to make money. That's a way to boost streaming profits.
So, I mean, I am curious, though, too, because when we talk about signups and that churn, a lot of that churn is sort of a function of the new programming that comes out. You know, you go into the office, everyone starts talking about this hit show, and then you're like, okay, let me sign up so I can do it. And then you kind of rinse and repeat here. There seems like they're trying to do that out of cycle now. It's not really about, oh, we've got this great new content. It's just, oh, we're going to save you, $2 or $3 a month, so sign up.
And there's also some strategy here with the seasons. I mean, this is when people are going to be at home. This is when they're going to want to escape the cold weather and just be in front of their TV, watching movies, TV, and sports.
Yeah.
So it is a perfect time to try to get new
Do you
customers.
have all of those platforms that we had on the screen? Do you sign up for all those?
I have some of them. I did try to cancel one of them and take advantage of the Black Friday deal, and I didn't cancel soon enough.
Oh, really?
Yeah.
Did you call the FTC?
No.
Okay.
That's the next step. What about bundles? Because I read somewhere that one person called the history of media bundling and unbundling. It's like a constant cycle. Within something like Disney, they can bundle Disney Plus and Hulu and ESPN together. But are you seeing more of those bundle offers, or different platforms teaming up together?
Yeah, we're definitely seeing more bundle offers. That Disney Hulu package, they are doing a Black Friday deal for it. And I think we'll probably see more of this down the line. The media industry is pushing for consolidation because the competition is so stiff.
So they want bundles yet again?
Yes.
All right. Hannah, this is great stuff here. And I mean, just, we go through the numbers here and we talk about the discounted prices. $10 for Hulu. Mm-hmm. $1. That's your Black Friday deal.
$1 a month?
$1 a month. Hulu and Disney with ads, that goes from $11 down to $3. Max goes from 10 down to 3, so on and so on. You get the gist there. Even Paramount.
So you couldn't do the $1 a month Hulu, or was that it?
It was for Peacock, actually.
Yeah. Oh, so you're the one person still subscribing to Peacock. Hannah Miller, everyone. Bloomberg's very own. All right. We're not done yet, right? The show's
we're
not
not
over.
done.
Okay,
Yeah.
I was just double checking. I always have to double check.
The week
here.
is not over
We're going to
yet.
set you up. No, are you sure?
Yeah.
Because I
I'm
want
positive.
it to be over.
I know, there's no one
It is.
in behind us, but yeah.
Of course, tomorrow is a holiday, though markets are open on Friday for a truncated session. We're going to set you up for what markets will have their eyes on over the next 24 to 48 hours. This is Bloomberg. Welcome back to The Close as we wrap up today's show ahead of the U.S. Thanksgiving Day holiday. Here we're going to set you up for what to watch over the next 24 hours, and you won't be watching U.S. markets because they'll be closed, Scarlett.
You can watch some football games in the U.S., but Thanksgiving Day means bond market, stock market is closed, so we're going to look ahead to some European data, and there's quite a bit. 3 a.m. Eastern time, if you're so inclined, Spain CPI.
Spain CPI, we're going to see, of course, we know they've been dealing with their own economic issues over there, particularly inflation. Be interesting to see what that trajectory has been over the last month.
And there's Eurozone consumer confidence at 5 a.m., so that too may
Is anyone confident in the Eurozone right now?
This is a really good question. I think since the election, that's a very open question, too.
Oh, and let's do Germany. They got issues, too, right?
Absolutely.
Yeah.
That's another concerning area.
All right, well, Germany CPI out at 8 a.m. Eastern time. Of course, we will be back. The close will be back on Friday. It will be an earlier show because of the markets closing earlier that day. Please join us on Friday, but stick around today for Balance of Power right here on Bloomberg.